Hey, what's up, everybody? It's Josh again here, and thank you so much for watching this channel and watching this video and being a subscriber to this channel. I hope you're enjoying the videos here so far. Today, I'm just going to discuss and just sort of share my own opinion why you don't need a financial advisor or financial planner, however you want to call it. And this is just my take, and personally how I look at it in a perspective as like a normal person who wants to invest in the stock market but wants to have minimum costs therein to invest. All right, so let's get into it. First of all, let's take a look. What are the costs that are in funds that you want to invest in? So first of all, we look at expense ratios. So here we are on the screen. I've already opened it for you. So let's just understand expense ratios in general. So expense ratios cover the operating expenses of a mutual fund or an ETF, including compensation for fund managers, admin costs, and marketing costs. So in simple terms, an expense ratio is a convenience fee for not having to pick and trade individual stocks yourself. So this is from a certified financial planner, however you want to call it, financial planner, financial advisor. And it has costs. So let's take a look at the investment that you will have with a mutual fund and an ETF. All right. So let's look here. I already opened it for you, so you won't have to Google it again. So the average expense ratio for actively managed mutual funds is between 0.5% and 1%. Okay. So it says it rarely exceeds 2.5% from the investor opinion. All right. So now, one second. Sorry. Let's come down here so we can have some calculations regarding expense ratio. So here's how that might play out with two hypothetical funds. Okay, this is just hypothetical, so this is based on the calculation. So you make an initial $1,000 investment in a fund with a 0.63% expense ratio, and then invest $6,000 per year for 30 years. So the expense ratio will be equivalent to $6.30 per $1,000 invested, assuming your fund earns an 8% average annual rate of return for 30 years. Okay, so here's a hypothetical fund. Investment would be $744,137.86 after accounting for fees. It would be worth this much. Okay, so the expenses that were incurred are this much, $85,000. And then let's see, if you choose another fund with slightly lower expense ratio with the same contributions, okay, same performance, but with a different expense ratio, it's 0.31. That means $3.10 per $1,000 invested in the fund. Okay, so before fees, your investment would be $744. It's the same as this one. Accounting for fees, it would be worth $700,000. That's a huge difference from what you have here. You're paying 44, you're paying 85,000, paying $43,000 here. Now, some people say it's a low number. It doesn't matter, because if you're gonna wait 30 years, you're not. Okay, let's make a calculation for the sake of this video. But before that, let's look at the index funds first. I mean, the ETFs. Let's talk about ETFs first. So we get to compare the expense ratio. Now, I've opened here. What are the best index funds or ETFs that are in the market already? So it's the same way of looking at mutual funds. If you're in a mutual fund, you're hiring a financial advisor to pick the funds for you. You pay them a fee, of course, or to pick the stocks for you. Compared to an ETF, where it tracks or mirrors the index. What I mean index is Let's talk about the S&P 500 index. S&P 500 index carries the biggest companies in the US. I mean, as per market cap, of course. And so let's take a look at here. So I'm gonna look at two of these ETFs over here. It's the Vanguard S&P 500. It tracks the S&P 500 index. It's one of the largest funds in the market. Okay, so this is an ETF. Expense ratio is 0.03%. Okay, so that means for every $10,000 would cost you $3 annually. So that means you get, for every $1,000 you get 3 cents. They charge you 3 cents. So let's use this one, number 3, the SPY. So it's the same as the Vanguard, weighted with the S&P 500. Okay, and it says here the expense ratio is 0.09%. That means for every 10,000 you're charged $9 annually. So let's use that. Anyway, guys, so here's the SPY. So before we go to the calculator, so these are the holdings of SPY. You can see here it mirrors the exact weight of the index itself. So in a way, it kind of mimics the price movements that are happening within those. But take note, ETFs are a group of funds that has stocks in it. Okay, so you have, by percentage, of course, you have Microsoft, which is 6%, Apple, which is around more so 6%. In a way, if this is trading in the market, if Apple fluctuates on the upside, or it gets has a uptrend momentum, and that means on the ETF it will also show, it will also fluctuate on the ETF, and it will greatly affect, because I think it has one of the biggest weights here, Microsoft and Apple. Okay, so here that's what you have in your SPY. So let me just go to the management expense ratio before we move there. So here is the MER, management expense ratio. Before that, it is the cost of buying or selling any security for the fund. It's not included in the management fee. Rather, these are transaction costs expressed as the trading expense ratio on the prospectus. Together, the operating fees and the management fees make up the MER. So before we do something, so here you can see management fees as 0.39, so an example. Okay, 0.39%. Total annual operating expenses to 1.17. So if you add it all together, the individual investor needs to calculate the MER, or what you just said, the management expense ratio, which is 1.56%. Okay, let's use this one and we'll compare it to the ETF. How much is the ETF? Let's use SPY. So SPY is 0.09%. Okay, so just in our calculator, so initial investment, let's put $1,000. All right, let's say you're 30 years old, you want to invest your money while you're young and probably retire by 60, so 30 years. Fund expense ratio in percentage, so let's use this one, 1.56. all right, 1.56. Now let's use the example of what we have here, investing $6,000 a year. Okay, so let's do that, $6,000. Okay, rate of return, this is the expected rate of return. Let's try to Google it again. What's the rate of return, average rate of return for S&P 500? I think it's 10%. I think S&P 500, 10%, around 10%. So let's put 10%. Okay, assuming you get the 10% rate of return, let's calculate those. Now this is the ending value. Okay, this is the gross amount. You actually have 1 million, but the net with fees is 810. So you're paying $292,000. Okay, let's move on. If you think that's a low amount, you're insane. But let's go here. Let's use what we have here in SPY. So let's calculate that again. See, the SPY is charging you how much? 0.09%. Let's put it there. 0.09%. And let's calculate that. Assuming you get 10% rate of return as well. That's crazy. So if you can see, same gross amount of $1 million, the ending value is at least $1 million, and you're only paying 19,000, short of 20, it's over $20,000. So it's insane. You're paying $200,000+ for the fees itself. And imagine, I mean, just doing the math, it says that it's eating up all of the investment money that you've made. And so guys, if this resonates with you, I hope you think through this before getting a financial advisor. I think the reason why people need like financial advisors or financial planners is mainly for the emotional support. It's because a financial planner or advisor can actually tell you, hey Josh, it's okay, I have your money, it's in safe hands, I will manage your money. Yeah, you're paying me 1% management fees, but it's for the emotional support. But if you go to them thinking they can beat the market, then you're definitely wrong, because almost 90%, I think the statistic says, I think for emotional support you can go to other people other than financial advisors, especially if you're investing. I wouldn't go to a financial advisor or a fund manager to manage fund. It's gonna cost you a lot of money. And yes, emotional support, maybe they can give you the assurance. Yeah, see, this is not to step on the jobs of financial planners or financial advisors. I highly respect them and know that they are doing what they could and have learned. Most of them are really math majors in terms of the calculations, and they can give you a very specific rate, this and that, and it's their job. They have to be paid well for it. They have to be respected for it, especially if they're doing this for others. But for a normal Joe like you and me, I don't think you would really need to have a financial advisor. If you're asking me now, Josh, what is your advice then? I would suggest that you can actually invest in ETFs instead, and put your money there instead of going to somebody and doing the legwork for you. You do the legwork, you study the markets, everybody has to. You straighten your financial responsibilities, you take care of your debts, and as money comes in, you specifically discipline yourself to put a specific amount that you think is okay with you to put aside for investing in long term. So that's sort of my suggestion, and not to just gravitate towards finding a financial advisors. I kid you not, the first 2 years while I was working here in Dubai, so many financial advisors flocked to me, or call me, or ask me to meet with them. It's because if you have work and if you're not financially savvy, that's I'm gonna use that term, they are gonna be there to sort of guide you, and be like holding your hands, to say, hey, you know what, let's look at your finances. You earn this much, maybe you can deposit this much every year or every month. So by the time you're this will be your rate of return, and then after 10 years you get this money. Yes, it works, but look at the fees, guys. Look at the fees, look at the expense ratios. Don't miss the little details, because those little details compound to what we've just calculated. We were just calculating 1.56%. For a normal person, that's a tiny percentage. 1.56, that's nothing. If for a normal Joe, maybe you would think, if you're not financially savvy or if you're not reading anything about finance, you would think 1.56 is nothing. In 30 years, 1.56 annually, it's okay. But it's a lot as we've calculated. And so, guys, this is actually an average, or so like a conservative fee. So some mutual fund managers charge probably less than 2%. And so, yes, that's my sort of suggestion to you guys. Get a broker, put your money on an ETF, do a dollar cost averaging. Every month, put a certain specific amount, deposit on your brokerage account, and do that for the next 10 years. Or if you are if you are a sort of person who wants to trade as well, then keep watching some of the videos in here, because I'm gonna show you a few of the things that I've been doing while I'm investing on the stocks that I'm picking using my brokerage account. I'm also trading a certain amount so I could get short-term gains while I'm in the market. So wait for that. And if you're new to the channel, you know that I love the concept of value investing. So if there's a channel that I would recommend for you to watch, it is in Everything Money. It's like three guys talking about making stock analysis, and then they give you the perspective of value investor, and the other guy is giving you the perspective of a day trader or a swing trader, I would say. And the other guy is the one who's like you, who's asking all the the non-financially savvy guy questions. So you get to see how these guys really dig into the discipline and the process, which is very important for us investors, and just the mindset of not being affected by hype stocks, hype investors out there in YouTube. So okay, that's it for me. I hope you learned something from this video, and comment and subscribe as always. Thank you so much for watching. I'll see you on the next one.